Hi everyone, welcome to today's video. So there is a lot of noise that is being made that US has almost $37 trillion of its debt. It's a ticking time bomb. It can go off any minute and you will lose all your wealth. We have news anchors who are kind of creating a lot of noise that US is about to go bankrupt and you will go bankrupt with it, and certain other markets are only going to survive, US is not going to survive. So on this video I'm going to help you understand the entire concept of government debt, US's current 36-37 trillion dollars of debt, in very simple, easy to understand language. Even if you are a class 10 student, you'll be able to understand that how this debt impacts you, how it impacts the stock market, the Indian stock market, US stock market, how you should be restructuring your investment decisions. You'll get data-based clarity. This is not a speculation, sensationalization video. I will tell you the entire story in very simple, easy to understand words. I myself invest a lot of money into the markets. I run a hedge fund. I help people invest their money as well. So I'm going to give you an investment oriented commentary, economics based commentary on this topic. My only request would be that please watch this video till the very end. So let's go point by point. Point number one is that you must understand that what is the meaning of a country level debt and how does it differ from when you take a debt in order to buy a house. So let me help you understand that difference first. It will make the entire video much simpler for you. So let's say that you go to Goa and you love a house and you want to buy it, but your bank balance is 10 lakh rupees, but that house cost 1 crore. So you require 90 lakhs more. Will you be able to buy that house? The short answer is maybe, if someone gives you a loan or a debt. And something very similar happens at a country level also, that a country or a country's government has to incur a lot of expenditure in terms of running its government, in terms of making new investments, in terms of helping out other nations, in terms of making future investments within its own country and outside, etc., etc. So basically it needs investment, it needs money, and it does not have that money to begin with. So what does it do? Well, it goes and raises debt. Okay. So how does a government actually raises debt? Because if, for example, you want to buy this house in Goa and you want to raise debt, that 90 lakh rupees, how would you go and get this 90 lakh rupee? Well, most likely you are going to go to a bank or a friend and say that, hey boss, give me like 90 lakh rupee. The bank will check something called as creditworthiness of your account. They will say that, hey, what is your job like, how much money you have in your bank, etc., etc. And then they will make a decision whether to issue this 90 lakh rupee of debt to you or not. And every year you will pay a certain rate of interest. In India's case, most likely you will be paying approximately 8% rate of interest on this 90 lakh amount. So this is how you raise debt. Okay. But in government's case, what is the difference? Well, do they go to a bank? The short answer is a no. Right? They don't necessarily go to a bank. Okay. And also, if the government, for example, Indian government hypothetically says that, you know what, we are only a $4 trillion economy. We want to become a $5 trillion economy. We require like $1 more trillion of debt. Will they come to you? Will they issue a referendum and organize a referendum and get like additional $1 trillion of debt sanctioned from somewhere? The short answer is not really. They will not even seek your permission. If they want to raise $1 trillion of debt, the modus operandi is very simple, or the way of working is very simple. The government issues something called as T-bills, right? These are bonds, right? And these bonds are sold to bidders, right? Now, this bidding, for example, this piece of paper is bought by, let's say, someone like me, right? And I say that here I have $1 trillion. And here is my $1 trillion, you take it. And every year, now I own this piece of paper and you, Indian government, are now liable to pay me, let's say 5% rate of interest on this $1 trillion that I've given you on every year basis. So this is how a government raises money or raises debt. Now, the counterparty here was me. The counterparty could also be Japanese government. The counterparty could be Chinese government. The counterparty could be a corporation, etc., etc., right? So there can be a lot of counterparties when a government is issuing debt. Now, here is the magic part, that in case you want to buy this house and the bank here refuses you to give 90 lakh rupees and you are unable to raise that debt, what will you do? Well, you will become sad that, hey, I'm unable to buy this Goa house, right? And yeah, there is nothing that can be done. And that's it. That's end of story. You failed to raise debt. But can the government fail to raise debt? The short answer is operationally no. Now, how exactly does that happen? So here, what did I say? That, hey, if the government wants to raise, let's say this time US government wants to raise additional $1 trillion debt, what can they do? Well, all they need to do is find a counterparty. Now that counterparty can be the government's own banks. For example, RBI can be a counterparty. The US Fed can be a counterparty to buy its own debt. Okay, so this is how it works. So in simple words, the government can itself print its own debt and can take as much debt as it's like. So then the natural question comes that if the government takes too much money, then you know what? Is there like a issue with that? So the answer is yes and no. And it all comes down to this equation, which says that profits is equal to revenues minus cost, right? Now this equation holds true at a government level also. For example, the government collects taxes from you. That's how it makes majority of its revenues. So revenues are nothing but a proxy of taxes. Cost means that how much expenses is it doing, right? So these expenses includes what? This includes interest repayment, right? Interest repayment plus the everyday running of government affairs. So that also cost money, right? So this will be operational expenses and a bunch of other expenses. Now, as long as this equation remains not profitable or not positive or not negative, but as long as an indication can be given that, you know what, this equation is somewhat sensible, right? Now, what is the meaning of this equation being sensible? So let me compare it to a company. So let's say that I run a company called as Wisdom Hatch. Now, this is a company that I run. Now, every year I'm generating like profits, profit in year 1, profit in year 2, profit in year 3, so on and so forth. Company is strong. This is positive. But let's say that I get a year in year 5 where I am like in year 1, 2, 3, I generated 1 crore of profit. And in year 5, I ended up generating 5 CR of losses. Now I am a net negative company. Now, will you get scared? The short answer is maybe, maybe not, because you will say that, okay, maybe this is an exceptional year for you. You have incurred some losses. Maybe in the future, you will improve upon, you will be able to enhance your revenues and you will eventually get profitable, right? So what are you doing, right? You are assessing my company's credit worthiness by doing a revenue forecast, profit forecast, right? So this is what you are doing. Now, this is done at a country level also, that for example, this number can be positive or negative. For example, many countries, for example, they export a lot. Example, China. So it exports a lot to US. It exports a lot to India. So they are net exporter country. But on the flip side, US is a net importer country and it has been a net importer country for a fairly long period in time. But that does not make the US economy inherently bad. Why? Because the expectation is that sometime in the future, the US government is going to pull up its revenues at a crazy scale, which will offset all its losses. Okay, so to say. And in order to play this equation, right, or play this game, the government raises what? The government keeps on raising a lot of money, keeps on taking a lot of borrowing, and they keep on throwing on different infrastructure projects, different companies, etc., etc. In order to do what? In order to generate something called as growth, right? Why growth? Because this growth eventually generates enough revenues to offset its cost, and eventually at some stage in the future it will generate profits. So this is the complex equation of the government as to what government is eventually trying to do. Negative profits or more borrowing is not necessarily bad as long as credit worthiness is there. Now, contextualizing it to the current debate that US has approximately $36-37 trillion of debt, one important point or data fact that you need to know is this. So take a look at this, and what you would notice is that US has constantly expanded its debt. For example, its debt as a percentage of GDP has constantly been expanding. In 2020, it breached 100%, and now it has breached approximately 120%, right? That's what the data is, and it will breach approximately 200% in 2050. Important key takeaway is that right now you're trembling with US has $37 trillion of debt. It doesn't matter. Okay, it will have like maybe $75 trillion of debt in the next 10 years. Who knows, right? Point being that this number is okay as long as indication can be given that growth will be generated enough from the US and it will remain a credit worthy party. That's it. Now, what is the meaning of being credit worthy? What does it exactly mean? How do you visualize that? Well, it's very simple. That if, for example, if the business environment in the US is not good, if companies are not setting up bases there, if companies are not moving to the US, if people are not getting richer, so on and so forth, there are many indicators of this credit worthiness. It's not as if that US will default on its debt. US can always print more debt, give it to itself, and keep on borrowing more and more with time. Then a natural question comes that why sitting in 2025 so much hoopla is being created, that debt has gone so much, debt bubble is going to burst, Ray Dalio is warning us, so many investors are warning us. So what exactly is happening? Why so much like nonsense is happening? Well, psychologically speaking, what has happened this year is that US is supposed to repay $1 trillion of debt as repayment on its overall debt. Okay. So this is number one, a psychological figure that, hey, $1 trillion of debt repayment needs to be done, or interest debt repayment needs to be done on the debt itself. So this kind of hits you hard, right? So this is one. Again, go back to this figure. There is no problem. US in the past has repaid crazy amount of its own debt. It's not as if that this is the first time debt is rising, etc., etc. So please do not panic. This is point one. So then comes point number two, that, hey, recently we read that, hey, Moody's has downgraded US's debt. Here, a counter argument is that this is not the first time Moody's or S&P Global have downgraded US as a sovereign. This has happened in the past also. Now, ratings, when they are downgraded, they can be upgraded also after 6 months. Again, depends on what? It depends on creditworthiness perception of a certain country. But US now, for example, take a look at this statement. What you will figure out is that almost 30-40% of millionaires in the world actually reside in the US alone. Now that is crazy, right? You have the best customer base in the US. So that does not mean that US is going to default tomorrow or in our lifetime. So please be aware of these facts first. Now let me take you through 6 key impact that this increased debt is likely to have on you in your lifetime. So number one impact is that US is going to increase its debt repayment. This is likely going to happen. So the rate of acceleration of debt is high, and this is what the worrying part is. Now what does this mean? Now again, we can go back to that equation, right? So which means profit is equal to revenues minus cost. Now here, if you have $1 trillion of debt repayment, which has to happen every year, the government will have to figure out a way to increase its revenue fast as well. For example, if this is growing at these two arrow speed, now then revenues also need to somewhat match up. Now, how would government revenues increase? Well, number one, taxation in the world will increase. Now, this is going to happen. There is nothing that you and I are going to be able to do about this. For example, recently, Donald Trump has taken a series of actions. For example, if you're an NRI living in the US, trying to remit money in India, you will have to now start paying 5% tax. He has banned Harvard from taking international students. He has pushed a lot of companies like Apple to set up base in the US. Why? Because they are trying to boost up their revenues. So this is like one way or one angle of increasing their revenues. Long story short, tax is going to go up, or tax collection has to go up all across the globe, right? My understanding is that, for example, countries like UAE are genuinely able to attract businesses due to low taxation. US, by using its gun trade war, very good consumer base, they will bring in a lot of businesses. Net losers here will be countries like India, unfortunately, because we do not have that attractiveness in terms of bringing foreign capital. Is this my viewpoint? No, many of you will get pissed, and it's fine. I don't care. Simple point is, look at how much FDI is coming in India. Last 10 years, the FDI growth rate, CAGR, is only 4.9%, not even 5%, 4.9%. This is very slow growth in FDI. An additional point is that you will say that how are you relating this point, which is in the US, to India? Well, because US dollar is traded across the globe. Almost 70% of world trade happens in US dollar. India also trades in the US dollar only. So anything that happens in the US gets impacted or hit in India. So this is point one, pillar one. This is the first impact on you. The second key impact on you is that in case you are investing in the stock markets, you will see a lot more volatility. Why? Because the debt market and equity market somewhat used to have a relationship. Now it's broken down. But typically speaking, and here you will see that 20-year treasury yields have been going up. Now, what is the meaning of 20-year treasury yields going up? Well, it means that the interest rates that is offered in terms of holding US bonds or US debt, that is being offered more and more. Okay. So let's say that in 2010, a 20-year treasury used to offer, let's say, 4% yield. Now in 2025, that same treasury is offering you 5.5% yield, right? So 5.5% yield means that if I'm holding that treasury bill, I will be getting every year 5.5% from the US government. So this is a 150 basis point delta, okay, which has been created on this instrument, which means that bond attractiveness has gone up, or there is more incentive for investors to hold bond. Now, noob investor, people who do not know anything about stock market and bond market, what they will think is that, you know what, bond may, if I'm making like 5.5, why will I even go to equity market? That's not the right question. For example, the size of US bond market is equal to the size of US's equity market. It is not by default, it is by design. Why? Because both equity capital and bond capital are important. If, for example, there is a situation that equities are only giving you 5.5 and you have to take so much risk, you see this, right? I mean, it's going up and down. This is called as volatility. There is no real volatility in terms of this yield, okay, when it comes to bond market. This is the amount that you will anyways make. So if you are making 5.5% on equity and 5.5% on bond, why will anyone in the world invest in US equities? No one will invest. So therefore, the concept that you should know is called as equity risk premium, right? So this is what is more important. What it simply means is that, hey, if bonds today are offering you 5.5, investors today will start asking that, boss, will I be able to make at least, let's say, 2 to 3% alpha on equity market? Will I make like 5.5 plus 3%, 8.5% by going to the equity market? If the short answer is yes, then this ERP or equity risk premium is kind of justified going to the equity market. People just assume that, hey, you know what, money will just simply move out of equity market and go to the bond market. So it becomes like even government's responsibility to give you like a sensible return from the equity market. Now you'll say, okay, oh, government gives like return from the equity market. Yes. Why do you think Chinese equities do not perform? Because the government does not want it to perform. Why do you think Japanese equities do not perform? Because the government does not want you to perform. Now you'll say that, okay, Japan is not growing, therefore, okay, fine. What about China? Is China not growing? China is growing, but its equity market on a 20-year basis has not done anything. Why? Because the government does not want the equity market to perform. In India and the US, the governments want the equity market to perform. Why? Because these are crooked markets. Now, what is the meaning of crooked markets? It's very simple. SIP, okay, give it to AMC. That AMC will give you like a basic return, whatever, like 9-11% in India, right? Or 9 to 12% in India, slightly lower than the benchmark. And bond rates are like 8%. So you are getting some ERP or equity risk premium here. So that is how the entire game is designed from the top. If you want to understand it, well and good. If you're not, it's fine. Long story short, the implication for you is not that as if that, equity market will not give returns or something like this. Equity market will continue to give returns. Important point for you is you must learn how to trade volatility. Now, what is the meaning of volatility trade? So for example, just like before making this video, I was chatting in my NRI community, right? And just today, the markets are about to open in like around another 45, 50 odd minutes in the US. And what has happened is that Trump today has come out and announced that, boss, I'm going to mess up with EU now. Okay, so European Union, I'm going to put tariff on them. Last month, he was doing the same thing with China. And what happened in China when this trade war broke out between US and China? This was the dip. This is the volatility that you could have potentially purchased. Now, I don't know if this volatility will happen. Maybe it will happen till here. Less impact, maybe some impact, maybe no impact. Point being that there are going to be these type of volatile phases. If you understand how to invest in these type of volatile phases, then only put your money in stocks. Otherwise, simply go buy a land, simply go buy some gold and enjoy life. Okay, there is just no point in going to equity markets anymore. Okay, so this is how it goes. This is the reality that I'm telling you. Point number 3, the cost of borrowing keeps going up. Now, this again ties into the point about volatility, and this is probably the most important key takeaway that I will tell you from this high debt is the fact that volatility in the world will go up. Now, and people do not like it. When I say that volatility in the world goes up, they are unable to imagine what is the meaning of volatility. See, now volatility can be seen in multiple ways depending on the asset class that you're studying. For example, here I showed you that stock market volatility is like this. Volatility high would look something like this, that it goes up really fast, comes down really fast. In the past, this used to be smaller, right? This wave pattern used to be like the range was smaller. Now, what other implications does it have? Well, if you study the bond market, right? And when you read that, hey, 20-year treasury yields are going up, they are hitting like whatever 4.5%. What does that mean? Well, it means that the cost of borrowing for everyone is going up, right? So for example, if you are looking to buy a house, let's say in 2010, you could have maybe like borrowed money at 7%. Now, because the base rate itself is going to 4.5, now what is the volatility on this interest rates? Well, it will go up to maybe 9%, 10%. So this general cost of borrowing in the economy is going to go up. Now, what does this lead to? Well, this leads to non-aggregation of assets by middle class. For example, what has happened in the last 5-10 years? Well, one of the key trends that you're witnessing right in front of you is that middle class has been priced out of buying homes. or houses or real estate. This has happened in the last 5 years. I was one of the earlier influencers who said that, you know what, in 2022, I started aggregating real estate like crazy, right? I have purchased a ton of real estate now. Very happy with that decision. Why? Because buying real estate or buying real estate is going to get more and more challenging. Now REITs is coming, bunch of other different things are coming, that all is there. Okay. Long story short, because of this cost of borrowing increase, anything that is bought on debt, it will get harder and harder for the middle class to aggregate. This is a problem, right? So this is a key impact that will happen to you due to this rising debt, and you will see this playing out in your lifetime. Then comes the next point that, okay, fine. Okay, I'll not buy a house. How else does it matter to me? Well, again, you will start seeing some certain trends, and this is called as increase in transitory inflation. Now, what is the meaning of transitory inflation? See, you must have read episodes like hyperinflation, that Venezuela, Mexico, they all had like currency crisis, bunch of different problems, that one day you can buy a bread with like 100 pesos, next day you have to buy it with 1000 peso, and the day after that 1 lakh peso. So now that is called as hyperinflation. These episodes you remember. But when it is transitory inflation, that is very hard to keep a track of. Let me prove it to you. How many of you know that medical inflation in India is close to 14%? Very few. Okay. You would not even be understanding it right now. Now, let me ask you something else. In the last 10 years, what has been the average growth rate of salaries for the middle class in India? Average growth rate of salaries. It is only growing at 0.4%, not 4%, 0.4% CAGR in the last 10 years. So what is happening is very simple, that jobs are growing at only 0.4, or salaries are growing at 0.4, and inflation is growing at 14% for a bunch of different people or different services. This is like one service that I've picked, but on an average, segmental inflation for the middle class will at least be 10%, right? So that is there. So why is this happening? Well, again, because of the rate of increase of debt, because every time government prints debt and it decides how much trillions of dollars it want to print debt, what happens? Well, the value of money or value of dollar or INR both goes down, or the purchasing power of this goes down. Now, if that is happening, that's a real problem, and this reflects in inflation. Now, unfortunately, the way economists design inflation or retail inflation and all that stuff, that is a cooked up number. It's not really working out on paper anymore. And this will keep on going up. Now you will say that, okay, you know what, that this way though the world will get crushed. So you are wrong, right? Okay, so see, this is what is going to happen, and this is the next big change that, again, what I'm seeing, it's the ballooning of social security. Now, social security has become a political tool. For example, in India, everyone is talking about reservation. Everyone is talking about free atta dal chawal, all that stuff. That is happening. That is happening in the US also. That is happening in Canada also. So social security programs are ballooning. So what this leads to is that it leads to creation of only two classes of people. One is top 3 to 5%, right? So this will be category 1. Then we used to have a big middle class, and then we used to have lower class. Okay. Now what will happen is that this entire second category will vanish. Okay. So you will be either top 3% or you will be the bottom 97%. This is where the game is moving. And who do you think protects, or what protects this 97% from creating a revolution? Well, it's social security. So as long as people are getting free food, medicine, this, that stuff, they will be okay. They will not bother too much. Yes, they will keep on wondering where their savings are going, this, that stuff. But long story short, they will not revolt against the government, and they become a vote bank for the government, right? So this is the bottom line, and this is what the impact of really high escalation of debt is, practical impact. Natural question comes that, hey, I'm very worried after listening to this video. You are like a pessimist person. You say like bad things. Do whatever you like. Okay, so I'm not here to please you. I'm here to tell you facts. Do whatever you feel like. Now you'll say that, okay, I want to slow down. I don't want to fall in this 97% bottom people. What can I do? See, 100 different things that you can do. Learn about creating business, find better jobs, go abroad, etc., etc. That's not the point. I want to speak about it from an investing viewpoint. See, there are two types of assets right now. One is growth assets. For example, when inflation or hyperinflation or transitory inflation is there, gold goes up, stocks goes up, real estate goes up. People are celebrating rise of gold. Cool. Did Bitcoin not go up? Bitcoin also doubled from 2025, more than doubled. You have real estate which has doubled. You have stocks which have doubled. So it's not as if that only gold is growing in isolation. These are all growth assets. So please put majority of your money in growth assets. Whatever spare money you don't need. Second is assets which appear to be growth assets but are not. A classic case study is EPF, VPF, now or PF. They grow at 8.5%. Inflation for you is growing at 10%. Now, how exactly is it protecting your wealth? It's not. It's just illusion of retirement planning, this, that stuff. I'm just telling you point blank, how to hardcore facts, do whatever you like, okay? So long story short, this is the situation. You don't need to worry too much about that, hey, debt is escalating. You should worry if you are clueless, if you're brainless, if you're not looking at the data and you're just somehow wondering, oh, we'll keep on doing SIP and we'll continue to get rich. Learn to trade volatility. Do not invest in slow growth assets. Invest in inflation protection assets. If you understand the gravity of these last three statements, and if you can be tax optimized, if you're rich, if you have 1.5 crore plus capital, definitely learn how to tax optimize. I'll put a link also in the description if you want to speak with my team who can help you get more tax optimized. I hope that this was a useful video and accordingly you will restructure your investment process. Thank you so much for watching and I'll see you soon.